Hello and welcome to the Token City Show. Today with us we have Lawrence Wintermeyer. He is the CEO of Avrio Worldwide and the executive co-chair of Global Digital Finance, GDF, which is an organization that promotes digital assets and decentralization in the financial sector. Hi Lawrence, welcome to the show.
Hey, Avrio, how are you doing?
Doing good, how are you?
Yes, I'm well, thank you.
All right, let's jump in. My first question for you has to do with the GDF report that was released in 2023. One of its key takeaways is that asset custody has revealed itself as key to scalability in our sector, and the report also links this to mass adoption. Could you please tell us more about this, unpack it for us?
I most certainly can. And first, to set out that GDF is actually a not-for-profit members association that focuses on standards and advocacy and runs an open innovation platform. So the digital asset custody report that we produced, which we referred to in our annual report, was done in partnership with the International Security Services Association and 20 of our joint members, and included a lot of the big global custodians, as well as a lot of the new digital asset custodians and kids on the block. And so I'm sure you've heard "not my keys," not my coins. This refers to, in the native cryptographic asset market, so Bitcoin, ETH, other cryptographic currencies, tokens, to what we would probably call non-custodial wallets, which are little things that look like this, that you plug into your computer and you actually self-custody your Bitcoin on. And that's been the most popular form of custody services for many people in the cryptographic community. But as Bitcoin ETFs, which are actually ETPs, but we've seen with BlackRock and Fidelity, after the approval of those ETPs, the growth of that market, custodies are actually provided, or custody services are provided by custodians. And so that's shifting the game a bit. If you want an ETP, you're going to use a custodian for your, in this case, crypto ETP, which is like an ETF. And there are all sorts of issues for those sort of service providers. Now, with an ETP, the KYC, know your customer, has been done, so there is a reliability that the customer is a bona fide customer. They don't have to, worry about things like that. But that's not the case with Bitcoin and Ether, when digital asset custodians, whether they're traditional or new ones, are looking at custodying your crypto. The issue of where you live and where you've bought your cryptocurrency and what the regulations are hugely important. The issues around ultimate bankruptcy and solvency laws in that jurisdiction are ultimately important. And then there are all of the idiosyncratic requirements that come from different public protocols or private protocols on tokens, their governance models, and how they work. So, at the onset, there are a lot of different variables for custodians and digital asset custodians to particularly focus on, which makes it either prohibitive from a cost perspective or a complexity perspective to easily custody those, those assets. And to put it simply, when you're a custodian, your job is the safekeeping of assets. So ultimately, when people buy digital assets and are looking at third-party customer services, what they expect is when they want to, for example, sell them, that they're going to be there, they can be sold and redeemed, and that they can get their money. And so the industry is really working through its solutions now. And I have to say, for a rather complex problem, it's working at a good clip. But back to your point in your question, we're not going to scale this through society and mass adoption with lots of retail users unless we can get a lot of this solved. And then certainly it's going to be more difficult, or in fact as difficult, if not more difficult, to scale the tokenization of real world assets, such as debt, securities, stocks, real estate maybe, or other things, until we work through some of these practical problems. But a lot of great collaboration going on in the global community. So we're looking forward to this year's next set of solutions.
Absolutely. You know what I just realized there? Um, there's sometimes terminology that encompasses one thing or another. My concept of digital assets is like the whole of the assets, be it crypto coin, cryptocurrency, or securities. So that's why I was interested to know your opinion, because I thought it was interesting that custody, which in the securities world is very common, right? Necessary for scalability, but
Yeah.
yeah, yeah. So maybe if you would like to maybe add a little bit to that, what do you see happening, taking place with custodians as it pertains to real world assets rather than cryptocurrencies and so on?
Well, see, you raise a really good point in talking about even securities custody, because the securities, and let's look at public market securities that are traded on stock exchanges, have a reasonable degree of interoperability. You can buy American stocks here in Europe, but not all of those stocks, or maybe you're on the debt side of thing and looking at bonds, they're not all necessarily dematerialized. So they're sitting electronically on systems right now, but still may very well have share certificates that are held with custodians until redemption or settlement comes. And so, if you think of real world assets, the most important thing, and we start with stocks, bonds, securities, the question is again, is it a dematerialized stock or bond, meaning that there is actually only an electronic form that can be migrated to a digital smart contract? Or are there still physical share certificates around for that? So is there a physical, artifact that needs to be considered? And I'll just extend that a bit further, and let's come back to securities. The importance of that, I think, is that, we've seen in real world assets, which is, a term the industry has adopted. Many people don't like it. People speaking about commodities, for example, gold. So there's a lot of stuff going on in the gold market. HSBC has got a tokenized gold product it put on its Orion platform last year. But if you start talking about physical assets, and rather than trading, a synthetic derivative of the physical asset, or a managed future, you've got all of the issues around where is that physical asset being stored, and how do I connect that physical asset and the provenance of that physical asset with the digital record? We could go on to property, even through deeds, entitlements, and all sorts of physical things. And so I would say that, for the most part, custodians and institutions are doing a pretty good job of working through the complexity of that sort of problem. But, from 40,000 feet, if you're a custodian now, there is a single record of fact. You're, with securities, you're settling at the end of day. You typically have a settlement cycle of, 2 or 3 or 4 days, depending on the underlying asset. And new digital ledger technology comes along where the technology theoretically allows you to do everything in real time or atomically. And so that actually, whilst it presents an opportunity, presents many challenges for the way securities, for example, work today, in that most of the processes, the systems, whether it's from unit accounting to settlement, don't work that way. And so there's a big change that needs to be implemented in the wholesale system, in the markets, and in the rails in order to effectively make that happen. So everyone says, oh, hey, great, technology, with digital technology, we can do, atomic settlement. I mean, we didn't need blockchain and smart contracts to do atomic settlement. That's what digital technologies offer us. But certainly in the context of the ledger being, in this case, the unit of record rather than it sitting somewhere in a custodian's SQL database, and issues around how quickly we can settle, DVP, et cetera. Those are actually very, I think, material issues that the industry is working through. And the great thing about it is that the industry is working through this. I mean, for the most part, a lot of these technologies have been around for more than a decade, 12, 13, or 14 years. And so, there's a head start on this stuff, but the newest area, I would say, is the tokenization of real world assets.
Mm-hmm. Yeah. Understood. Let's go to the next question. I wanted to ask you follow-ups to your answer, but let's go on so we can cover more things. With the report also in mind, it states that financial institutions are going out of proof of concept phase to go into the production phase. Can you please tell us how this looks like? Maybe provide us names, any information you might want to add, what has changed, and so on.
Yes, indeed. And this was probably one of the most important milestones for financial institutions and real world assets in 2023. There have been a number of use cases. In fact, we've clocked about 50 different use cases over the past 4 or 5 years. So there's a lot that's been going on in this space, but 2023 had some milestone announcements and projects, which I'll talk about in a minute. Again, what I would say is that from my perspective, we've been in financial institutions looking at blockchain and use cases for near a decade now. So it's not as if anything new has happened here. And then there's been a lot going on in the last 4 or 5 years. It's just a bit quiet. And then to be honest with you, it's difficult to compete with the noise around cryptocurrencies or Bitcoin, certainly over the past few years and with FTX, et cetera. But the breakthroughs really start with debt, and that sovereign debt, government bonds. The EIB had a number of bond issues. There were 3 rounds, in fact, 4 if we include Euroclear in 2023. Coming up to the end of 2022, the ones that were important involved Goldman Sachs, SocGen, HSBC, all small ticket sizes, and often in a consensus network, not on a public network, but demonstrating that you can have dematerialized sovereign bonds working on blockchain or distributed ledger technology. So that's important. In 2023, towards the end of last year, there were a couple of notable pilots. First, JPM's intraday repo pilot with Onera, Aberdeen's money market fund with Archax, and again, Euroclear did an EIB bond issue around November of last year. We've also got JPM and Apollo's mutual funds looking at moving to production. So I think that's an example of some exciting things going around. But I think the thing about 2024 is that in the institutional space, most people have their heads down. It's debt, vanilla products like money market funds, ETFs, to prove not just within the organizations, but to shareholders, to regulators, and to investors that this technology actually works. So that's pretty exciting.
Yep. In fact, there's overwhelming agreement in the fact that this technology actually works and its potential. What do you think from that lens is required for more companies to start applying it, more companies basically going out of concept phase into production phase? What do you think needs to happen for that to be more at scale besides custody?
Well, it's a great question. We need, first of all, more products across more asset classes, and you don't go into a supermarket that sells one or two things. That really is limited choice for, in this case, investors. And so, it's a classic scaling problem because whilst financial institutions still need to prove that this stuff is scalable, and that's where we are, uh, it looks like we can scale things, but the interoperability is probably the biggest issue. So what we don't want to do is create, permissioned networks and walled gardens all over the community so that, FIs are getting cost and efficiency savings and saying, great, I'm clocking up a few hundred basis points of efficiency for moving this asset onto a smart contract. But the token is on Token Island. I call it escape from Token Island. And broadly, none of the other market can access it. So interoperability is really the thing I would say beyond custody that people are really focused on this year, because the custody train now is moving and sorting some of the problems out that we spoke of earlier. And so more of an asset selection and a greater degree of interoperability. And this is part of the practical issue in the institutional space, in that typically, because regulators are averse to public distributed ledger technologies of the public blockchain for all sorts of reasons, resilience, cyber issues, we need to be able to get to an interoperable space where we know that there's a bona fide asset that's been tokenized, that's sitting in a platform, but that I can access transparently through a networked market, because there's a degree of interoperability and this all works together. I would say the other bigger issue is cash on ledger, or how you get your US dollar, pound, euro, peso, whatever it is that your unit of fiat is, transformed into cash onto DLT technologies. And the important bit about that, as far as financial institutions are concerned, is that they're less confident about retail stablecoins, although there are use cases emerging, and they're more focused on things like deposit tokens, which we've seen recently from SocGen. We saw JPM coin, a couple of years ago. And so it's that level of deposit token or assurance for the stable coin that FIs are waiting for, because even though we see some central bank digital currencies coming down the pike, they still look a bit far away, over the next 36 months to really start scaling things in the institutional market, from 2024. So more heads down, interoperability, getting the on and off ramp, cash on ledger rails, working with the appropriate players, and again, focusing on changing some of the dynamics we've spoken around custody and settlement. I would say that is high on the agenda for 2024.
Yep, agreed. For our audience, Lawrence has mentioned token deposits. That's tokenized deposits, an alternative to potential alternative that is gaining traction and interest to the use of stable coins as a means of, like Lawrence said, to have cash on chain. So our last question. You have an eagle view of blockchain and tokenization. You are in touch with financial institutions, the largest ones, organizations like the OECD or Davos or GDF itself. And then you also are in touch with fintechs like Token City. So from that privileged point of view, how do you evaluate the degree of collaboration and coordination between the different actors pushing the industry forward?
Yeah, I love that question, because that is exactly what we do in GDF. And in fact, I had the privilege of, coming out of the markets in 2014 and taking the job as the Chief Executive Officer of Innovate Finance, which was the UK's fintech ecosystem. And I think I got that job not because I was, particularly famous in fintech, but I've spent a career of working with innovators, startups, incumbents, and regulators, and that's pretty handy right now. So GDF's mantra, most people think we're a trade association. We don't do lobby. We do advocacy and education, but more than anything, we are an open collaboration and open standards platform, but funded by, as a not-for-profit, by a small and discreet, group that we call our advisory council. And so I think the important signal that we see in certainly in the financial institution space is that collaboration is alive and greater than it ever has been. And not without constraints, but part of that is many FIs, as you know, have had their own corporate venture capital firms. They've been partnering with fintechs. They've been working with organizations like GDF who run open and again, we run an open platform. We invite all of the trade associations and all of the other folks that have relationships with fintechs and FIs to collaborate. We're not precious. We don't need to own anything. Our job is to try to move the needle on open collaboration. And the reason for that is, if you look at the challenges or the barriers around the things we've spoken about today, like custody, like interoperability, like cash on ledger, the only way we believe it's going to work is having everyone come together and agree these interoperable standards until we can see that things are scaling, and then everyone may choose to go away and compete. But it seems to me that with the way that technology and innovation is moving, and we just have to look at Gen AI, large language models, and what's going on in that space, you're better incented to collaborate because some of these technologies really require great expense and deep pockets. What I would say is that it's been difficult over the past 4 years, from COVID to the failure of SBV, Credit Suisse, and Switzerland, because if you look at the numbers, and we've had this macroeconomic volatility, there are a lot of job losses in banking, there are a lot of job losses in professional services. Depending on where you are in the West, tech funding and fintech funding in particular has been down anywhere from 30 to 60%. So we've taken a lot of the risk capital out of the hopper, which creates the volume of early stage firms and the incentives for them to come into the market. So I think we need to keep an eye on that, and that we've lost the great population of fintechs we've had. And I'd just like to add one more comment that I think is important. I think what we've seen post FTX, and anyone in the advocacy or lobby space will tell you that the crypto community, the centralized exchanges, the VASPs, the CASPs, haven't been good at collaboration. And I think post FTX now, and with the success of things like Bitcoin ETFs, ETPs in the US, we're seeing a greater level and degree of collaboration from a lot of the larger exchanges. I'm fortunate in that we felt through the GDF era, we worked with a number of the global exchanges that were really open, but none of us could prevent an FTX, and these are the sort of things we don't want to see happen in new fintech markets. We want confidency in the fintechs of the players. So a great halcyon period of open collaboration, but we're just very mindful that funding is clipped, and we're in a new, more volatile economy.
Agreed, completely agreed. We are reaching the limits of our time allocated, so I'm gonna have to let you go. There's a lot of other things that I would love to ask you. Hopefully,
I'll have to come back.
Yes, thank you so much. We'd love to have you on the next time. Thank you so much, Lawrence, for being on the show.
Absolute pleasure, sir. Really enjoyed this. Bye-bye.
Bye-bye. Take care. That was Lawrence Wintermeyer from Global Digital Finance, GDF, an organization that promotes digital assets and distributed ledger technology in the financial infrastructure, in the financial sector. Sorry. So I hope that you liked the interview. We will see you here next time. Thank you so much. Bye-bye.